Good morning, everyone. This is Rob McDougall from Zhang Financial here with your economic update. Today is Monday, August 26, 2024. So before we go into the economic releases that we had previewed last week, we're going to go through two items that occurred last week, which are non-standard in nature. So last week on Friday, Fed Chairman Jerome Powell actually had a financial discussion, Jackson Hole, Wyoming, at a symposium. During that, he said that the time has now come for policy to adjust. So simply stating what we all know, the Federal Reserve is going to start cutting interest rates this fall, going to start with this September. Doesn't give us any clarity on the number of times, magnitude in total, but pretty certain, we're almost 100% sure we will get our first interest rate cut in September. Secondly, last week, there was a revision to the U.S. nonfarm payroll number. Now, I laugh a little bit. We've talked about it on this podcast. I've mentioned it many times. I have very little confidence in the nonfarm payroll numbers that we've been seeing because they don't reconcile with two other indicators that we look at. So we kind of thought the numbers were abnormally high over the last year, and we got confirmation that we were correct with that. So there was a revision to the prior 12 months of non-farm payrolls ending March 2024. So go back 12 months before that. The revision was pretty stark. It was 818,000 jobs that we claimed we had created that were not there. Wouldn't be surprised if that number is understated as well. We say this because for a couple of reasons. It's not great that we have less jobs. However, the silver lining to this, and the reason the market didn't react negatively to it, is that wage pressure and inflation concerns, but particularly the wage pressure that leads to that. It would be less so if you had 818,000 less jobs than you thought. So the labor market, without question, is weaker than many market participants had expected. But nonetheless, it is still relatively strong, and we'll look at economic data, and we'll continue to argue at this point. Most of the economic data suggest solid growth here in the United States and not portending necessarily a recession on the near-term horizon. So a few other things last week, not nearly as monumental, I think, as the Fed chairman's discussion or the revision to non-farm payroll. We had initial jobless claims that come out every week. But that was actually a little higher than expected, 232,000 versus 230,000. Not a big deal. We actually had some housing data that was across the board better than expected. So first was existing home sales, beat by 30,000. That was good. But new home sales was the big winner last week. The expectation for July is that new home sales were 630,000. It came in at 739,000, so just blew away consensus estimates. Also, building permits came in last week just a little better than expected, a little over 1.4 million. So the housing data last week, good. So in total, the data from last week, I would say, looks pretty solid. And again, the concerns over a near-term recession or even a recession early next year, just don't see it in the numbers yet. I would say neither does the Federal Reserve Bank of Atlanta, who for the third quarter now still expects GDP growth of 2.0%, which would be really solid, coming off at 2.8% growth in the second quarter here of 2024. Inflation expectations last week, they edged up a little bit, not a big deal, but the number, the absolute number is actually extremely low. Expectation for average inflation in the next 10 years, 2.13%. Now, when we take a look at Fed funds future and the expectations for what's going to happen with rates, with the Fed cutting, 100% chance we're going to get at least one cut in September. September meeting, the announcement will be September 18th. But there is a 37% odds built in that we'll actually get two rate cuts during that meeting. By the end of the year, the expectation is of us getting at least four cuts. Has now risen to 76%. Just a week ago when we did this podcast, it was 59%. So I think based largely, maybe some on the economic numbers, but largely on the discussion by Jerome Powell on Friday, The expectation is even greater for an increased number of interest rate cuts by the end of the year. So to wrap all that up, how did the markets react to this data last week? It was another strong week here in the U.S. markets, both in equity and in fixed income. So on the equity side, S&P 500 up nearly 1.5%. The big winner for the week was small cap. Small cap, Russell 2000 up 3.6%. In terms of the international markets, developed markets ex-US actually better than the S&P, up 2.7%. So we're keeping an eye on that. This developed markets ex-US has trailed the U.S. markets for most of the last 15 years, but it's been holding its own and sometimes actually exceeding domestic stocks over the last couple of months. So on a year-to-date basis now, the developed markets ex-US, that index is up 9%, S&P 500 up 19%, so it's still got a lot of room to gain. But again, we're just keeping an eye and seeing at some point we know international will outperform the U.S. It hasn't for a long time. We're not sure when it will, but we're keeping an eye on it. Fixed income, another strong week last week. We had yields that were down. 2-year yield down 14 basis points. The 10-year yield down 8 basis points. So the Bloomberg U.S. Aggregate Bond Index up 0.67%, and now on a year-to-date basis up 3.6%. So let's move on to economic data that will be delivered this week. Today we have durable goods ex-transportation that are coming out for the July numbers. The expectation is a huge rebound in durable goods orders. So for the month of July, durable goods, that was down, and it was surprising. Durable goods were down 6.6% on a month-over-month basis. The expectation is for July that will improve to a positive 4%. So the durable good ex-transportation number in July, it was positive, it was 0.5. It's expected to be flat here for the July reading. We'll have a GDP growth revision for the second quarter. There's no expected change to the already reported 2.8%. Friday, this is the big day. Big three: inflation, spending, and income metrics. So the PCE core are coming out for July, personal spending for July, personal income for July. So for PCE core, we'll start off with core PCE, expected to be the same as we saw in June, which is an increase of 0.2% month over month. The PCI headline number, though, is expected to increase because it was abnormally low, surprisingly low for the month of June. It was only up 0.1%. That is expected to be positive 0.2%. So we're not really expecting much of a change in terms of the trajectory of inflation based on the PCE release this Friday. Personal spending, however, that's expected to go up. So the consumer continues strong. So when we say we don't see necessarily a recession occurring or even on the horizon, consumer spending is part of that. In the month of June, consumer spending was up 0.3% month over month. For July, that's expected to be up 0.5% month over month. In terms of personal income, no expected change. Month of July was up 0.2% month over month for June. For July, also, it is expected to be up 0.2% month over month. Last metric we get is just a revision to the University of Michigan Consumer Sentiment Index, which was reported at 66.4. The expectation is the revision is going to be positive, up to 67.8. So that's it for the recap of last week and a preview of this week's economic activity. Thank you very much for attending. We'll hope to see you next week. Thank you.